Hello, Marc Ostwald from ADM Investor Services International with some thoughts on the risk appetite which has developed this week and what the prospects are in terms of the broader spectrum of the US rates and putting that also in something of a global context. What's been noticeable, and it predates the Fed's decision to signal that it's now on a pause last week, is that we have started to push back quite sharply on US rate expectations. We are now effectively saying that we're not looking for, we're not discounting much of a chance, or certainly not a more than 45% chance of a rate cut, another rate cut before next June, which is really quite significant given that we had been pricing in at least 2 to 3 more. So where does that leave us in terms of the US bond market, and indeed how is that impacting markets elsewhere? So to my next 3 charts, basically looking at the US 10-year Treasury yield, I think the significance in all of these, and I haven't drawn the trend line in on this one, is that we have broken that long-standing downtrend that we've had since November of last year when we started to discount the Fed basically reversing some of last year's rate hikes. 190 is very much a pivotal level. If we break above 2, then it's going to be something more of a pain trade emerging. If we look at how that's impacting elsewhere, we're seeing much the same sort of picture. So let's have a look at JGBs, where we're still sitting around with the hope that the Bank of Japan might institute a small rate cut, but we're steepening the yield curve in Japan quite significantly. We're now back well within the range that we were in terms of the yield curve control at minus 0.5 and seem to be on a fairly sharp uptrend now. And the same actually indeed applies to Bund, the 10-year Bund, which is significant insofar as the ECB's literally only just restarted its QE program, and yet ever since the announcement we've had a steady rise in yields, and there too we are bumping up against the key level at minus 0.2. So those are going to be levels to look at very carefully. I think the more important aspect is if we have a look at my 5th chart, which is the US 2 10-year spread. Now, I think everyone can remember how back in August when we inverted the curve to minus 5 basis points, we were talking about doom and gloom on the global economy. And now, obviously, with the greater optimism surrounding the US-China trade talks, I would basically add that there are a lot of ifs on this. If a phase 1 deal is agreed, then they may well implement some rollback of the tariffs, which would in principle be the more significant part of that, insofar as that would be better for global trade, whereas a trade agreement with all the tariffs still being in place would not be so great. But we're now in a situation where we're basically not discounting gloom and doom on that front, and we're effectively implying greater optimism, but it also implies that we're also going to have higher refinancing costs, given that underlying Treasury yields will inevitably push up the cost of borrowing and cost of refinancing. Inevitably, obviously, there has been some credit spread tightening, but at some point, what we need to really have a close look at is the volatility of financial markets, and that's my final chart today. This is the Move Treasury Volatility Index. It's fell very, very sharply. That's the green line, but now rebounded as we're starting to see this up move. And when one looks at that VIX volatility chart, one always starts to think down at this level, the next move almost inevitably is likely to be up. So as much as there's some euphoria around the US trade and China trade negotiations, care needed.